The Canadian dollar just did something it hasn't done in 2 weeks. It rallied hard. Not because Canada suddenly fixed its economy, not because oil prices exploded, not because the Bank of Canada made some brilliant move. It rallied because the US dollar is collapsing. And that's the part nobody wants to say out loud. Right now, the loonie is sitting at its strongest position against the greenback since late January. Currency traders are watching the US dollar index like it's a patient in the ICU. And Friday, we're getting the US jobs report, non-farm payrolls, the number that can move billions of dollars in minutes. So here's the question. Is the Canadian dollar actually strong? Or is it just standing still while the US dollar falls off a cliff? Because there's a difference, and that difference is about to cost someone a lot of money. Let me take you back to how we got here. For months, the US dollar has been the safe haven, the fortress. When the world panics, money flows into dollars. It's been that way since the Bretton Woods Agreement in 1944. Doesn't matter if you're in Tokyo or London or Sao Paulo. When things get messy, you buy dollars. But something shifted in the last few weeks. The Federal Reserve has been holding interest rates high, 5.33%. That's supposed to attract global capital. Higher rates mean better returns. Money should be flooding into US assets. That's the textbook version. Except it's not happening anymore. Instead, traders are betting the Fed is about to blink. Inflation is cooling. The labor market is softening. And Jerome Powell has started using words like disinflation and progress instead of vigilant and restrictive. Wall Street hears that and smells blood. They're pricing in rate cuts, maybe as soon as spring. When rate cut expectations rise, the dollar falls. It's mechanical. And when the dollar falls, everything priced against it goes up, including the Canadian dollar. Now Canada's economy is not exactly firing on all cylinders right now. Growth has been anemic. The housing market is frozen. Household debt is at record levels. The Bank of Canada already cut rates in January, from 5% down to 4.25. Tiff Macklem, the central bank governor, basically admitted the economy needs help. So why is the loonie rising? Because currency markets don't care about your domestic problems. They care about relative value. The Canadian dollar isn't rallying because Canada is strong. It's rallying because the US dollar is weak. And that's a completely different story. Think of it like this. You're in a race. You don't need to run faster. You just need the other guy to trip. Here's where it gets interesting. The US Nonfarm Payroll report comes out this Friday. This is the monthly snapshot of how many jobs the American economy added or lost. It's one of the most watched data points in the world. Governments, central banks, hedge funds, pension funds, everyone stops what they're doing and watches this number. Expectations right now? About 170,000 jobs added in January. If the number comes in lower, it confirms the Fed is winning the inflation fight, but losing momentum. That pushes rate cut bets even higher. The dollar drops further. The loonie keeps climbing. If the number comes in higher, it means the labor market is still tight. Inflation could reignite. The Fed stays hawkish. The dollar stabilizes. The loonie gives back its gains. So the fate of the Canadian dollar, right now, is tied to how many Americans got hired last month. That's the absurdity of currency markets. Your fortunes depend on someone else's data. Let me show you the math that nobody talks about. Canada sends about 75% of its exports to the United States. 75%. Energy, lumber, autos, agriculture. Almost all of it goes south. When the Canadian dollar strengthens against the US dollar, Canadian goods become more expensive for American buyers. A stronger loonie is bad for exporters. It squeezes margins. It makes Canadian manufacturers less competitive. But here's the flip side. Canada also imports a ton from the US. Machinery, electronics, consumer goods. A stronger loonie makes those imports cheaper. It helps Canadian consumers and businesses that rely on American parts. So who wins and who loses depends entirely on what side of the trade you're on. If you're a Canadian oil producer selling to refineries in Texas, you're getting hurt right now. Your product just got more expensive in dollar terms. If you're a Canadian manufacturer buying steel from Ohio, you're celebrating. Your input costs just dropped. Currency moves create winners and losers. Always. And The media loves to frame it like the loonie. Rallying is unambiguously good news. It's not. It never is. Now let's talk about what the Bank of Canada is actually doing while all this happens. Tiff Macklem cut rates in January, but he also said something curious. He said the bank is prepared to act if economic conditions change. That's central bank speak for we're watching this closely and we might do something dramatic. Canada's inflation rate is sitting at 1.8%. That's below the 2% target. The economy is barely growing. Unemployment is creeping up. The housing market is in a deep freeze because mortgage rates are still too high for most people. So why isn't the Bank of Canada cutting rates more aggressively? Because they're terrified of the currency. If the Bank of Canada cuts too fast and the Fed holds steady, the interest rate gap widens. Money flows out of Canada and into the US, chasing higher returns. That would crater the loonie. And a collapsing currency brings its own problems. Imported inflation, capital flight, loss of confidence. So the Bank of Canada is stuck. They need to support the economy, but they can't afford to let the dollar fall too far. It's a balancing act on a tightrope. And the rope is on fire. Here's the part that should make you uncomfortable. The rally in the Canadian dollar over the last 2 weeks has almost nothing to do with Canada. It's entirely a reflection of US dollar weakness. And that weakness is based on expectations, not reality. Expectations. Markets are betting the Fed will cut rates soon. But what if they're wrong? What if the jobs report on Friday shows the labor market is still strong? What if inflation ticks back up in February? What if the Fed decides to hold rates higher for longer? Then all of this reverses. The dollar rallies, the loonie crashes, and everyone who positioned for a weaker dollar gets caught on the wrong side of the trade. Currency markets are brutally efficient at punishing people who bet on the wrong story. Let's zoom out for a second. The broader picture here is that we're living through a moment where the US dollar's dominance is being questioned, not overthrown, not replaced, but questioned. For decades, the dollar has been the undisputed king of global finance. But other currencies are starting to gain ground. The euro is stable. The yen is recovering. Even the Chinese yuan is being used more in bilateral trade. And when the Fed signals it might ease policy, while other central banks stay tight, the dollar's edge disappears. Capital flows become less predictable. Currencies that were considered weak suddenly look attractive. The Canadian dollar is benefiting from that shift right now. But it's a temporary benefit. It's not structural. Canada hasn't fixed its productivity problem. It hasn't solved its housing crisis. It hasn't diversified its export base. This rally is a gift. And gifts don't last. So what happens next? If the jobs report on Friday is weak, the loonie could push even higher. Maybe to 1.40, 1.39 against the dollar. That would be a 3-week high. Exporters scream. Importers celebrate. The Bank of Canada watches nervously. If the jobs report is strong, the rally evaporates. The dollar regains ground. The loonie settles back down. Everyone pretends the last 2 weeks didn't happen. But here's the real kicker. None of this addresses the underlying problem. Canada's economy is fragile. Growth is stalling. Debt levels are unsustainable. And the country's fortune is still tied to the whims of the Federal Reserve and the health of the American economy. The loonie isn't rallying because Canada is strong. It's rallying because the US dollar is weak. And that's not a foundation you want to build on. Currency markets are strange. They reward relative weakness. They punish overconfidence. And they move faster than any other market on Earth. Right now, the Canadian dollar is having its moment. It's at a 2-week high. Traders are optimistic. Headlines are bullish. But optimism is just another word for expectation. And expectations can change in 60 seconds. So when you hear that the loonie is rallying, ask yourself, is it actually getting stronger? Or is everything else just falling apart? Because the answer to that question determines whether this rally is real or just another illusion in a market built on them. Friday's jobs report will tell us which one it is.